I'm Darius McDermott from Fund Caliber, and today I'm delighted to be joined by Alexander Darwall and Luca Emo, managers of the European Opportunities Trust. Good morning, guys.
Good morning, Darius.
Good morning.
So, look, you formed Devon Equity Management almost 2 years ago, and you've been running the trust for over 20 years. How has the new working environment been? And I know you've added to your team. How's that all going?
Well, as you know, we've had some testing times, and we come through these times. So we've been stress tested, which is a really good thing to come through it. We've been tested in one or two portfolio stocks, about which we can speak later, perhaps, but also by all the COVID disruption. And I'd point to two things which have given us great heart. The first thing is because of our boutique culture, we've been able to have everyone who we need to have in the office, the investment team. We've all been together through long periods in the last couple of years. So we've worked together as a team, and I can point to a few instances where this has made a real difference in our performance, and I think we're going to see more benefits from that. So we've not suffered from the difficulties that the bigger organizations have about working from home. We've been able to work as a team, and we need to do that. So we've been able to do that, and I'm really pleased about that. The other thing is we've definitely improved the quality of the investment research team to an extent we've never had before. Luca and I have been joined by two. The principal one is Charlie Southern, who brings tremendous Asian and technology expertise, and he has given us the confidence to make investments that we wouldn't have done before. So I can point to specific examples where he's added to returns. And we've got a more junior analyst who we know well, who's done various stints with us before. So we're delighted we've got a better investment team than ever before. And as I say, whilst I can already point to the benefits of this, I am sure that the fact that we've been working together throughout the last 2 years physically in the same office, and we've got the right blend of expertise now, combined with the focus that we always look for, means that I think we're going to see more benefits from the way we've been working. So we've certainly been fully stress tested, and we've come through.
So talking about working practices, clearly we've all had to change because of the pandemic. And we've all used Zoom or other video platforms. Are you close to getting back to going and seeing companies again in Europe, or do you still think that's a little bit away? And has that been a hindrance? Have you had more personal time to delve into the financials? How do you feel on that front?
Well, COVID has been enormously disruptive, as you would expect. And there is no travel that we are undertaking the continent, and we haven't seen a continental European company face-to-face for 18 months. We are doing a few UK company face-to-face meetings, which I find huge value in it. And the sooner we can do travel again and meet companies properly, the better. It is something which has played to our advantage over time. So we need that to come back. I don't feel it's satisfactory doing Zoom and Zoom only. Interestingly, we have a good number of examples from our UK face-to-face meetings where we've taken these meetings, and a lot of the mainstream players have not taken the physical face-to-face meetings. We have one recent example where we were the only ones to take that opportunity. And again, I think it's a cultural differentiation between an energized, incentivized, very focused boutique culture and the mainstream culture. So again, that I think that is an advantage that plays out over time.
Well, that's a lovely segue into the UK then, because the trust can and does, and historically has done, held some UK companies as well as European companies. You're around a third invested in the UK at the moment. Maybe talk to us a little bit about why that is and whether or not that's at a historic high or a normal number for you.
Certainly the weighting of UK listed companies, and in that I would include Experian, though it's actually not technically, it's registered elsewhere. But if you take that group of companies, you're right, we are historically at a high. However, this has got nothing to do with any confidence I may or may not have in the UK economy. In fact, I don't have a great deal of confidence in the UK economy, but this is not the reason we hold these companies. These are global winners which happen to be UK listed. They're things that I simply can't get on the continent. And I'll just give you, if you look at the biggest one, perhaps Experian is the most important one to look at. It's currently our biggest holding. It's biggest business is in the US. Its second biggest business is in Brazil and indeed Latin America as a whole. The UK comes a distant third in their revenue generation, but they've got a market structure where they are the biggest and the best in a consolidated industry, where there are growth in the data and identification needs. It's a terrific business. There is no continental European equivalent. But this is a play on data and ID authentication, and it chimes with the direction of travel that regulators and politicians want to see. And that direction is empowering the man in the street to take control of his data and for his own data to be used to his benefit. And Experian help with that. I mean, they have a product called Boost, and Boost essentially is where if you want to cooperate with Experian, they will take some non-standard aspects of your data and thereby improve your credit rating so you can get credit at a cheaper price. This is exactly what the regulators and politicians want to see, and Experian is most developed and most able to deliver that product. So Experian is not there because of the UK, it's because it's got something which others don't have. I can't find elsewhere. It's the biggest and the best in a growing business and a good market structure. So that's one example. Relics would be another, where their biggest business by far is in America. It's got some business in the UK, but there's nothing special about the UK for its journals or exhibitions or legal business. It's much, much more US orientated. And indeed, the fastest growing piece of Relics, risk business, is a quintessentially American business because of freedom of information. And then finally, just to mention, just the other big one I would point to in our holdings, Genus, UK listed, but they're selling bovine and porcine genetics across the world. The big markets for that are America, North and South, and continental Europe and Asia. And the UK is a long way down the list. So none of these is a play on the UK. All of these are a play on global expertise of companies that happen to be UK listed.
Yeah, so the listing is irrelevant. It's just they're great global companies.
And you put it. I could have just given that short answer. I wish I'd said that.
I might add one more thing. Even by historical standards, we're not at the all-time high weighting in the UK, as the country of listing. Yeah.
So maybe then just a brief line, because this is an investment trust, you can actually hold very concentrated. Alexander's always been a concentrated investor. I've known him for 20 years. But with respect to Experian, and you've talked to us about why you like it, you actually hold more than 10%, which is something allowable in an investment trust. It's not in a fund. You're comfortable with that?
Well, Luca will give the precise weighting. It's not much more than 10%, but the precise weighting. But what the board put in place about 18 months ago was a restriction that whilst we can have a holding of more than 10%, we can never buy more shares in a company of a holding of more than 10%. So it can only sort of grow organically its weighting through performance here. So the likelihood of it becoming a materially big holding, of course I want it to become a materially bigger holding through good performance, but we have, if you look at the example of Novo Nordisk, which has had a spike in share price, when it got to 12%, I cut it back to about 10%. We took money out of Novo as part of risk management, portfolio management. I was not obliged to do so, but we took that weighting from 12 down to 10, and we redeployed that money in a couple of other stocks, and 2 new holdings, in fact. So I do like the concentrated structure, but one of the learnings from Wirecard is that I won't make the mistake of having too much in another company again. So it's very clear we feel more comfortable around the 10% level, and I won't be buying more when we're at that stage.
Thank you. That's very clear. Maybe then just one last question from me. Tell investors what type of circumstances really benefit the trust, and what sort of macroeconomic or environment don't help the trust, given your style of investing.
Yeah, it's a very good question. We try to build what we call a fund for all seasons, by which I mean we don't chop and change because of the economic environment, because we don't know what it's going to become. We don't know what scenarios. But I would say that QE has not been good for us specifically because we tend to have companies with more value added and less debt. Being intellectual property companies, they're less capital intensive and probably have gathered less debt. And I think one of the things that QE has done across Europe and indeed the US and the UK, but in the West in general, is remove the concern about building borrowings, about people's indebtedness levels. And we are much more concerned than the market generally. So I think in the context of a rising tide lifts all boats, that's not so good for us. We prefer structural winners through the cycle. So we're more relaxed about downturns and perhaps less excited about cyclical upturns than other people. I think we need, where we do well is where we've done good quality analysis and results show we've got it right. And just recently that has been the case. We've had a coincidence of good results, by which we're obviously very pleased, and we've got a bit of catching up to do. But I think a slightly tougher environment where people recognize the threat of inflation, where interest rates tend a bit higher, would be relatively less worrying for us. We could, our companies, I've mentioned some of them, like Genus, will be able to sell their genetics even with the higher prices, and they don't have much debt problems. Interest rates don't worry them particularly. This is a structural global opportunity we see rather than a cyclical. So we do best when we've done good quality analysis, and we do best when there aren't these flights of fancy that come that are fueled by irresponsible QE.
Alexander, Luca, thank you very much. If you'd like to receive more information on the European Opportunities Trust, please visit fundcalibre.com.